The consequences of linear investment thinking from the past. How the 2007-2008 crisis impacted many. 1. The destruction of home equity in the American dream. For millions, their home was their largest asset, their retirement plan, their safety net. When housing prices collapsed, home values fell 20 to 50%. Many owed more than the home was worth. Refinancing became impossible. Millions were foreclosed on. Losing a home wasn't just financial, it was identity shattering. 2. Mass job loss and career collapse. Entire industries were gutted. Finance, construction, manufacturing, real estate, and retail. Millions lost jobs and many never returned to their prior income level, had to switch careers entirely, lost professional momentum, lost employer-based health care. This created a permanent earnings gap that followed people for decades. 3. Retirement plans destroyed. People close to retirement were hit hardest. 401ks collapsed, pensions were frozen or cut, savings evaporated, retirement timelines were pushed back 5 to 10 years. For many, retirement became mathematically impossible. 4. Psychological trauma and long-term fear. The crisis created chronic anxiety, fear of markets, distrust of institutions, paralysis around investing, delayed re-entry into markets. This psychological damage caused many to miss the entire 2009 to 2013 recovery, which was more costly than the crash itself. 5. Forced liquidations at the bottom. Millions were forced to sell assets because they lost jobs, needed cash, couldn't refinance, faced margin calls. Selling at the bottom locked in permanent losses. This is the most devastating financial outcome. You never get to participate in the recovery. 6. The lost decade of compounding. Even for those who held on, the S&P 500 took 5.5 years to recover. Compounding stopped. Inflation eroded real value. Dividends were cut. People didn't just lose money, they lost time, which is the most valuable compounding input. 7. Generational damage. Families experienced college savings wiped out, children delaying education, intergenerational wealth transfer interrupted, increased debt burdens. The crisis created a multi-generational setback. 8. Exploding debt and credit destruction. People who lost jobs or homes, maxed out credit cards, defaulted on loans, saw credit scores collapse, faced years of higher borrowing costs. This created a long-term financial handicap. 9. Community and social breakdown. Entire neighborhoods were hit, abandoned homes, rising crime, collapsing local tax bases, school funding cuts, and community instability. The crisis wasn't just personal, it was geographic. 10. The collapse of trust. People lost trust in banks, regulators, rating agencies, government, financial advisors, and markets themselves. This trust gap still shapes behavior today. Key takeaways. Everything above should govern your investment framework. Seek survivability, nonlinear risk, decay, opportunity cost, and structural drift. The crisis exposed how fragile linear assumptions are. It punished anyone who relied on markets always go up, housing is safe, and buy and hold works everywhere. It rewarded those who understood nonlinear systems, regime shifts, and capital preservation. I hope you enjoyed listening. Like and subscribe for more nonlinear personal market and investment insights.